Hey, it's Jordan, and this is your Precious Metals Video Market Update. This video is being recorded on the afternoon of Wednesday, June 22nd, 2016. Thank you for joining me today. Starting off, let's take a look at the miners, and we have the daily candle chart here, GDXJ on the top, GDX on the bottom. And since miners made new highs in early June, they've basically digested those gains over the last 11 trading days or so. Now, initially in that period, there was some distribution, but something I've noticed over the last 4 days is that in 3 of those 4 days, you've seen accumulation. One indication of that is in 3 of those 4 days, the miners closed at or near the highs of the day. Now, generally speaking, when you're looking at corrections, they can take the form of uh, price, which is the one we all know, but also time. So markets can correct through time. They can consolidate for a long period without declining much in terms of price. That would be a correction in terms of time. So far we've had about 10 days of correction, but really it's been a correction in terms of time and not price. Now that could change and we can see more correction in terms of price, and I've shown some levels here which you can see. I mean, starting with GDXJ, I mean that could potentially decline to if it loses this support at 39, it could decline to 38 or a little bit below that. It could also decline to the line at 36, which is when we had the bad employment report where the market opened. So the open after that gap is at 36. With GDX, the open after that gap is about at 24. GDX closed at 25.50 today. GDX has been a little bit weaker, so I mean that's a target to keep in mind, and perhaps I don't think it's going to happen, but it's just something to keep in mind. The possibility that we get a bigger correction and we end up filling that gap, and then you'd have GDXJ going to 39 and GDX going to 23. Again, I'm not expecting that, but we have to keep all scenarios in play. Now, back to the comment about markets correcting in terms of time and not price. I mean, you can actually look at this price action since the beginning of May, so the past 7 weeks, and say that we've been correcting in terms of time through that whole period. Because if you look at where we are now, we're with GDXJ, we're right at the highs of early May, and for GDX, we're a little bit below that. That'll be more visible on this next chart when we're looking at the bullish analog for the Huey Gold Bugs Index. You can see the current rebound is in black, and you can see in terms of closing prices, it looks like we've basically been consolidating since the beginning of May. So that's something to keep in mind. In that, if this consolidation slash correction continues for another month or so, as the 2008 analog shows, then you could make the case that we've been correcting for over 2 months, 2.5 months, and again, that would be more of a correction in terms of time and not price. But again, we've been following the 2008 rebound quite closely. I see that on all my analogs, not just this one. And again, so this specific analog calls for more of a correction in terms of price over the next 3 or 4 weeks, but then moving a lot higher. Now, the recovery in general, as you can see, it remains on the overbought side, but given the action we've seen over the last 6 weeks or so, and the last 2 weeks, we're starting to get a little bit less and less overbought. We're still overbought. I mean, again, these are technicalities, but we're not as overbought as we were at the beginning of May, and not as overbought as we were a couple weeks ago. But nevertheless, it would be a good thing if we consolidate over the next month or so and work off more of that overbought condition. Then that would put the market in position to have that strong move higher, which you see in red there, which happened during the 2008 to 2009 recovery. Now, next and last, let's take a look at gold. It's pretty clear what's going on with gold. It has resistance at about 1295 to 1300. Gold closed above 1300, but then it had a bearish reversal immediately. I can't tell if it was the next day or the day after, but Anyway, gold bouncing a little bit today at close at 1268.90, so call it 1269. There's support at 1260. There's also some support at 1240, and then you have strong support around 1200 to 1210. 400-day moving average is at about 1180. So those are all the support levels to keep in mind. And given what we saw in the miners, I don't think gold is about to shoot higher through 1300 right now. It would be healthy to see more of a consolidation in gold before it makes another attempt at 1300 and breaking through. I mean, look at the commitment of traders report. I don't have that chart, but in the past, I've noted that 55 to 60% for the net speculative long position. Again, that's a percentage of open interest. 55 to 60%. That is really the peak that we've seen in the past. And gold got up to 54% in the last report. So there's been, I mean, there was a lot of there's been a lot of buying in anticipation of a possible Brexit, and so that certainly is moving the market, causing a lot of volatility here. But stepping back, another point I want to mention about that, I haven't shown this chart before, but if you look at 2003, 2005, and also 2009, there are examples of when the net speculative position was in that 55 to 60% range, and the gold continued to move higher over the next couple months. And so the reason is you actually see some commercials covering shorts. Now, if gold it breaks above 1300 very soon, you could actually see that where commercials who are generally defensive, they would need to cover their shorts because gold could make a bigger move higher. So, but anyway, as far as the COT right now, it is limiting gold's rise, but gold along with the miners, they are overbought. So if we get more consolidation, some of those spec positions would come out of the market, then gold would be able to break above 1300 potentially and have a good move higher to 1375 to 1400. But nevertheless, remember, it's really the miners that are leading. And we've been saying over the last week or so that we don't think gold is going to break above 1300 because the miners have been consolidating. So let's just focus on the miners as we already did in this video. And I think they're probably going to consolidate in the days and weeks to come. And if that is the case, then there will be a buying opportunity coming for those on the sideline, those with a lot of cash. But again, let's take our cues from the miners because they're probably going to break out before gold breaks above 1300 and holds above 1300. So that's my view, and that's all I have for today. Follow more of my work. Go to thedailygold.com. Sign up for my free newsletter. You get my free book, which is nearly 150 pages of research, all the best research I've done over the last couple years. I mean, I give away lots of excellent free stuff in my newsletter. And check out my premium service. Go to thedailygold.com/premium. Our model portfolio over the last 7 years is up 340%. That was as of last Tuesday or Wednesday, and during that time period, the miners were down 30%. So my service costs less than $1 a day. It's $150 for a 6-month membership. Well, thank you everyone for listening and tuning in. I really appreciate it, and I wish you all the best, and I hope to speak with you again in another video update in the next week or two. Thanks.